So here's a quick explanation of essential question number 4, version 4 from the spring of 2013. I'm actually doing this during the summertime, so it is a little bit late. Here's one which is a compound transaction. So it combines a purchase of a car, and it also has a relatively simple loan in it, and then it has you selling the car. And remember, anytime that you see the sale of an asset, you should consider the possibility of gains tax. And it has our usual combined tax rate and minimum acceptable rate of return. And so the parts you're going to have to worry about is purchase, sale, depreciation, gains tax. The payment's easy because it's just a single payment, but still it makes for a somewhat more complex income and cash flow statement. So let's go ahead and take a look at our income and cash flow statement for this one and fit in the bits and pieces and parts that we have here. So let's first go ahead and take a look at the purchase and sale of the asset. Remember, that does not happen up here in the income statement. The purchase and the sale of the asset happens in the cash flow statement. So what we have is the car being purchased for $20,000 here. Remember, it's negative, that's cash flowing out. And we said it was being sold in year 3 for $10,000. So there we've got the purchase and sale. Again, nothing happens around up here. Second component we have is the loan. So that's the loan, that's us borrowing money right now. And we have a single payment that's in year 1. The payment is split up into 2 components. There's the repayment of the principal, which is always down in the cash flow section. And then here's the interest component, which is right up here, and it's on the income statement. So again, it was at 10%, so there's the $20,000 being repaid, and there's the interest being repaid in year 2. And actually the loan part's fairly easy because it's a single payment. You don't have to go ahead and create one of those grand amortization tables. Next component to worry about is that you bought this asset. It's a 5-year asset, it's a car, and so you know how to depreciate it. You take 20% here, 32% here. You're just reading off the table and multiplying it by the cash basis. Sorry, that's right there. The tricky part is in the last year that you own it. What you're doing is taking only half the depreciation that you would otherwise had. So you're taking the $20,000 cost basis, multiplying it by the number of the table, and just dividing by 2. So there's the key feature right there, and this is actually one of the things that I look for. Getting down to net income is as expected. You take always going to be operating revenue, subtract off everything up through interest to get your taxable income, calculate your taxes, subtract your taxes to get you to net income. Net income just carries down into the cash flow statement. Also remember that depreciation comes back in from the income statement into the cash flow statement as a source of cash. So these are just copied down here. Now the last tricky part, and this is where a lot of the details are hidden, is in calculating the gains tax. And truthfully, that's one of the things that I'm just trying to look at quickly to see if you got the right idea on this one. So what you're supposed to do is take a look at the book value of the asset. So the book value is the $20,000 less all of this depreciation that you have right here. That's the book value, and you compare it to what you sold it to. So the way it works out is that you have a book value, which is something less than its $10,000 here. So you've been depreciating it just a little bit too much relative to its actual drop in value. You take the difference between those two, and if you depreciate it too quickly, you're going to owe tax. So this shows a gains tax which is positive, which means that you owe the government money, and you plop it in there. So just remember the sign convention is different. So this is just $20,000 less 40, less 6,400, less 1920. And then what I'm doing is taking 10,000, subtracting that, which is the book value, multiplying it by the tax rate, which is 0.4, and that's what the gains tax is supposed to be. That's what you owe the government. So remember, when you're adding these things together, you, again, add all these, subtract that, and that should get you what the net cash flow is. The last step is just the trivial part of finding the present worth of the net cash flow down here, and so it's just that value plus that one divided by 1 plus 0.05 plus that one divided by 1 plus 0.05 squared. And there you go. There is a explanation of essential question 4, number 4 from the spring of 2013.